Hi guys, so in today's video I'm going to be looking at 5 of the best dividend stocks to hold for every dividend investor. Now, dividend investing is simply where you center your portfolio around stocks that pay out a reliable and consistent dividend payment every quarter or every month. And essentially you're looking to build a portfolio of stocks that are going to pay you out passive income over time, and essentially you're going to be getting paid for not doing a lot. And often in the case with these stocks, the dividend payment does go up over the years. So your passive income is likely going to slowly increase year by year. And just quickly guys, before we get into it, if you do enjoy this video, be sure to leave a like and subscribe, as it really does help me out. So let's get started. So first up we have Coca-Cola, ticker symbol KO. And here are some core stats on the screen right now. As you can see, the dividend yield is 3.47%. So it's a fairly healthy dividend payout considering how big the company is. So Coca-Cola is a dividend king stock with 58 years of consecutive dividend increases. And just quickly before we carry on, a dividend king stock, for those who don't know, is a S&P 500 company that has a history of paying out a uninterrupted dividend streak of 50 plus years. Additionally, the payout ratio is 90%. So it is a little bit on the high side, as 90% of their revenue is getting paid out to shareholders. However, Coca-Cola is a very solid company that will most likely drive this down over the coming years, and we'll have a look a little bit more into why that could be the case in the next few slides. So their 5-year dividend growth rate is about 5.6%, which is a moderate to low rate. So there's going to be dividend growth over the coming years, most likely. However, it's not going to be anything too special. So as everyone knows, Coca-Cola is a market leader in soft drinks. They have over 500 brands worldwide. A lot of people don't actually know how many brands they own, some of which include Sprite, Fanta and Dasani. And their products are sold in over 200 countries, with 28% of their operating income coming from North America. So they are quite geographically diversified as well. So they are dominant in an industry which is quite safe against the worldwide economic crisis or a recession. So when the economy is down, people are still going to drink. They might cut down on their soft drink consumption, but for many it's just a part of their sort of weekly shopping and daily consumption habits. So people are generally going to continue to consume their products regardless of the current economic climate. So an area of concern for Coca-Cola is the declining soda consumption in some countries, as well as governments striving for healthier living conditions for people and implementing sugar tax. So just under 70% of Coca-Cola's sales do come from sodas. However, they have been diversifying quite aggressively into alternative drinks, which include energy drinks, certain juices, water and dairy products. And then the 3.47% dividend yield is quite high considering how solid the company is, and it's quite appealing to get this sort of dividend return from a company as solid as Coca-Cola. So next up we have Johnson & Johnson. Now Johnson & Johnson pay out a 2.64% dividend yield. Their stock is priced slightly higher than Coca-Cola. However, a lot of people can probably buy fractional shares for them. They are also a dividend king stock with 57 years of consecutive dividend increases, and their payout ratio is 51%, which is quite low, and it shows that they can comfortably pay out dividends each quarter with plenty of cash left over. So their 5-year dividend growth rate is 6.3%, which is again fairly decent. However, considering the dividend yield is relatively low, it would be nice to see this as a little bit higher, but considering how solid the company is, it's not too much of a concern. So they are the largest medical conglomerate in the world with a very diversified selection of products. They also have a wide range of consumer health and skin products, many of which you might find in your own home. This includes some quite popular names such as Clean & Clear, Listerine, Band-Aid and Johnson's Baby Soap. So 52% of their sales do come from the US. However, the rest of it comes from the rest of the world, showing that they do rely on America quite significantly. However, a large proportion of their income and their sales do come from the rest of the world as well. And in 2019, 25% of their revenue came from brand new products that had been launched in the previous 5 years, which equated to $4 billion per year of revenue. And this shows that this is a promising sign as an investor, because it shows that Johnson & Johnson strive for continuous research and development and innovation in their products. So through the ups and downs of life, as well as the ups and downs of the economy, most people are still going to be buying their sort of casual household health items that you use on a daily basis. So just because the economy is down, that doesn't mean that people are going to stop sort of buying face cream or buying mouthwash. It just doesn't happen. So they are quite recession proof and quite stable in that sense. And yeah, as I've just mentioned, they are a fairly safe company in a very safe industry. So they're therefore not likely to suffer too heavily during an economic recession. And then the dividend yield of 2.64% might not be the highest. It is sort of on the low side. However, the company is extremely safe, and this dividend yield is this dividend payout is going to rise every year. So it's going to grow over time. So next up we have 3M, ticker symbol MMM, and their dividend yield is 3.64%. They are also a Dividend King stock, which have 60 years of consecutive dividend increases, and their payout ratio is 71%. So again, that's a decent payout ratio. It shows that they can comfortably afford to pay out dividends each quarter with a lot of cash left over. So their 5-year dividend growth rate is 11%, which is quite attractive for a company to be investing in. And it's also encouraging to see that you're going to be getting a decent dividend growth over the years if you choose to invest in them. So 3M are a global industrial conglomerate which sells over 60,000 everyday products that are found in homes, schools, offices and hospitals. So their products are sold in over 200 countries, so there's plenty of regional diversification with this company. Only 39% of their sales come from the US, with 31% coming from Asia and the Pacific region, and 21% coming from Europe, the Middle East and Africa. So they do have a large geographical diversification with their products. They also have a massively diversified product range in terms of the markets and industries that they're selling in. So 27% of their income comes from the industrial section, or sector I should say. 25% comes from healthcare, 19% from safety and graphics, 17% from electronics and energy, then consumer products account for 12%. So a large diversification with their products. Another interesting point is 50% of all the products are consumables, which means that their customers will continuously come back to buy more in the future. 3M also have a continuous dedication to research and development, and over the past 115 years they have obtained over 100,000 patents. This gives them an incredible backbone of core products that cannot be copied, and it has also led to 33% of their sales coming from products launched in the last 5 years. So again, this is really encouraging to see that they're constantly innovating with their products. The dividend yield of 3.64% is quite good considering how sort of diversified their business is. And it's a decent yield to have, especially with the growth rate that they've got of about 11%, which is quite promising. So next up we have AT&T with the ticker symbol T. Now AT&T have a pretty nice dividend yield of around 7%, which is the highest I've got on this list today. They are a dividend aristocrat, which has 35 years of consecutive dividend increases. A dividend aristocrat stock, for those who don't know, is simply an S&P 500 company that has 25 years of consecutive dividend increases, rather than the 50 years that a dividend king has. Their payout ratio is 65%, which means that they do have a decent amount of cash left over after paying dividends, despite their high yield. So their 5-year dividend growth rate is only 2.1%. So there's probably going to be little dividend growth over the coming years to compensate for the high yields right now. So that is obviously a little bit of a concern if you're looking to invest in them. So AT&T, they are a telecom and media conglomerate that generate most of their income, 79% of it, from the communications sector that consists of wired and wireless phone and internet services for homes and businesses. They also have 20% of their income coming from the acquisition of Warner Media in June 2018. And between 2012 and 2018, AT&T spent more than $150 billion on maintaining, upgrading and expanding their wireless and wireline networks. So this contributes to keeping their business future-proof, as there is an extremely large barrier to entry for any new company looking to start up in the industry due to the high cost of startup. So the only real competitors in the USA are Verizon and T-Mobile, and also Sprint, which is more to a lesser degree due to their size. So AT&T is in quite a unique situation as they pay out a pretty good dividend payout every quarter, but they also have some potential to grow in the future with the implementation of 5G. So if 5G is a pretty big success across the world and it gets implemented to a lot of places, then they could see some share price growth in the future. So you've kind of got a double whammy there of growth and good dividend payout. So that is quite an exciting prospect if you're an investor in them. However, it must be said that there are some significant risks to AT&T as well. So the main risk that I can see with them is their streaming service that has some fierce competition in the form of Netflix and Amazon. They also have a large amount of debt that they need to pay off, while also needing to fund their 5G infrastructure. So this is obviously going to be a significant factor in the future of the company. If they have got this debt looming over them, then they have to pay that back in the future, then that's going to be a hindrance in the growth of the stock. So their dividend yield of about 7% makes them an extremely attractive company to invest in, with the potential to see stock price growth as well. However, there are certainly some risks associated with the business, especially if there are problems with 5G when it gets rolled out. And if 5G does cause some big problems with communications, then this could obviously hit AT&T quite significantly. So the final company I'm going to be looking at today is Realty Income with the ticker symbol O. Now, Realty Income pay out a monthly dividend, and their dividend yield is 4.58%. They are a dividend aristocrat stock with 25 years of consecutive dividend increases. They have also been paying uninterrupted monthly dividends since 1969. So they've got a long history of paying out dividends. So Realty Income is a real estate investment trust, also known as a REIT, and by law they must pay out 90% of their income to shareholders. So their 5-year dividend growth is 4.4%, which is relatively slow and steady. However, this is to be expected of a REIT, especially as they pay out a pretty nice 4.6% yield. So as I've touched on already, Realty Income operates as a real estate investment trust. So a REIT is essentially a company that holds a large portfolio of real estate funded by their investors, and they pay out a monthly dividend to their shareholders, which is obtained by the monthly rent from their buildings that they own. So 83% of rental income is generated by retail properties, followed by industrial warehouses at 11%, offices at 4%, and farmland at 2%, all of which are under long-term triple net lease agreements, which provide a solid cash flow and shift all operating costs to the tenants. So despite being largely reliant on retail properties, they do have over 600 different tenants across 49 different US states, as well as the UK. And their top tenant, Walgreens, only accounts for 6% of their revenue, and their top 20 tenants account for just over 50% of their total revenue. So they're quite diversified in terms of the tenants that they have. They also currently have a 98.5% portfolio occupancy rate, which is really promising to see, as it means that they're not missing out on rent due to their tenants being reliable and in a good financial position. So the retailers that occupy their properties are mostly grocery stores, drug stores, dollar stores, and convenience stores, as well as some entertainment buildings as well. So even though e-commerce is becoming more and more popular, while a lot of people worry about the brick and mortar stores, tenants that Realty Income work with tend to be largely immune to e-commerce. And also people will always need to go to the supermarket or a convenience store or a pharmacy, so the threat of continuous e-commerce is nothing to worry about too much. And with a dividend yield of 4.58%, they are a great dividend stock to own that not only pay out a monthly dividend, which is something that some people are quite attracted to, but they also give you exposure to the real estate market in a very diversified and relatively safe way. So that is all for today, guys. I know there's quite a lot of information in that video, but I would really appreciate if you hit the like button and subscribed if you did enjoy that video. Also be sure to comment with your favourite company from the ones that I've listed in today's video. Let me know if you're thinking of investing in them. I'd be really interested to find out. And yeah, apart from that, guys, thanks a lot for watching.